Before the trade even starts, you already decide whether you'll win or lose long term. Not by your entry, not by your strategy, but by how much you're willing to lose if you're wrong. That's the solution most traders never hear early enough. Consistent profit is not built on prediction, it's built on risk control. And if you don't master that, the market will teach you the hard way. You've been here before. You open the chart, see a setup that looks clean, and confidence creeps in. You think, this one feels different. You increase size slightly. You don't even notice you're doing it. Price moves a little in your favor and you relax. Then it pulls back. Suddenly your heart rate changes. You start negotiating with yourself. That single moment is where accounts are slowly destroyed. Risk management isn't a technical skill, it's a psychological one. The first rule you must live by is this: you never risk an amount that changes your behavior. If the potential loss makes you nervous, distracted, or hopeful, you're risking too much. You already know this feeling. When risk is too high, you watch every tick. You interfere, you move stops, you hesitate on exits. Smart traders understood long ago that the best trades feel boring. That only happens when risk is small enough to stay emotionally neutral. You don't size based on how good the trade looks. You size based on how calm you want to remain if it fails. This is where most traders resist. You tell yourself, if I don't risk more, I won't grow. But deep down, you've seen the opposite. Oversized risk leads to emotional decisions, and emotional decisions erase progress. Consistency begins when no single trade matters too much. If this realization already hits, pause right now. Like the video, subscribe to the channel. Share this with someone who keeps blowing accounts because they never learned this rule. The second rule follows immediately. You define risk before reward, always. You don't enter a trade thinking about how much you can make. You enter knowing exactly how much you can lose. That loss is accepted before you click buy or sell. When you do this properly, losing trades don't shock you. They don't trigger revenge. They don't push you into the next bad decision. Most traders lose because losses surprise them emotionally, not financially. You felt the difference. When you didn't predefine risk, a loss felt personal. When you did, it felt procedural. Trading smart means treating losses as costs, not insults. You stop trying to avoid losses. You focus on controlling them. This mindset shift alone separates consistent traders from emotional gamblers. The third rule is the one most people break quietly. You never move your stop to avoid being wrong. You've done this before. Price comes close to your stop, and you tell yourself, it just needs more room. But what you're really saying is, I don't want to accept this loss. Moving a stop is not risk management, it's fear management. And fear always gets more expensive the longer you feed it. You need to understand this clearly. Stops exist to protect you from uncertainty. When you move them, you remove protection. The great traders didn't survive by being stubborn. They survived by admitting when the market invalidated their idea. A stopped-out trade is not a failure. A blown account is. When you accept that, you stop arguing with price. The fourth rule changes how you view winning streaks. You don't increase risk just because you're winning. This is where ego sneaks in. You feel sharp. You feel aligned. You think, I'm in sync with the market. So you size up. And that's when the market humbles you. You already know this pattern. One oversized loss wipes out several disciplined wins. Trading smart means consistency in risk, not emotion-based adjustments. You let the edge play out over time. You understand that probability works in series, not in moments. A winning streak doesn't make you invincible. A losing streak doesn't mean you're broken. Risk stays the same because your discipline stays the same. Drop a comment if this rule has ever cost you money. Saying it out loud matters more than you think. The fifth rule is the most underrated and the most powerful. You stop trading when conditions or emotions are wrong. You don't trade because the market is open. You don't trade because you're bored. You don't trade to get back losses. You trade when your setup aligns and your mind is clear. Capital is preserved not just by stops, but by restraint. You've experienced emotional trading days. One loss turns into two. Two turns into frustration. Frustration turns into overtrading. And suddenly, you're not executing a plan anymore. You're trying to feel better. Trading smart means recognizing that state early and stepping away. Walking away is not weakness, it's professionalism. When you apply these 5 rules together, something changes. Losses become smaller, drawdowns become more manageable, confidence becomes stable instead of fragile. You stop measuring success by today's profit and start measuring it by rule adherence. Did you control risk? Did you follow your plan? That becomes your scoreboard. You also notice that the market feels slower, clearer. You're no longer chasing every move. You're waiting for conditions that justify risk, and when they're not there, you protect capital by doing nothing. That alone puts you ahead of most traders who feel the need to always be active. If this video is helping you see trading differently, like it, subscribe, and share it. These rules save accounts. Here's the truth most traders never want to accept. Consistent profit is not about being right more often. It's about losing correctly. Small, controlled losses keep you in the game long enough for probabilities to work. Big, emotional losses end careers early. You don't need a perfect strategy. You need controlled behavior. You need rules that protect you from yourself. These 5 risk management rules are not optional. They are the foundation. Without them, no strategy survives. If you made it to the end, you're already ahead of most traders because you're focusing on what actually matters. Like the video, subscribe to the channel, comment which rule you're committing to fix first, and share this with someone who needs to hear it before their next oversized trade. The market will always be uncertain. Risk doesn't have to be. And when you control risk, consistent profits stop being a mystery and start becoming a result.